Hi, my name is David Peevler, and I'm the Regional Director for the United States Securities and Exchange Commission's Fort Worth Regional Office. And it's my pleasure today to present to you tips on how to protect yourself from investment fraud. Before we get started, I need to give this SEC disclaimer, which you can see on this slide. Essentially, the things that I say today represent my opinions and do not necessarily reflect those of the Commission, the Commissioners, or other members of the Commission staff. First thing we want to cover is who is the SEC? The SEC is the nation's primary regulator of investments, with extensive responsibility over public companies, stock exchanges, broker-dealers, investment advisors, mutual funds, and even private offerings of securities. We're a federal agency headquartered in Washington with more than 4,200 employees in 12 offices around the country. My office is the Fort Worth Regional Office, and we have responsibility for Texas, Oklahoma, Arkansas, and Kansas. SEC and its employees have extensive expertise with investments and the investment industry, and we bring hundreds of enforcement cases in federal court each year to stop fraudulent and misleading investments. So let's move on to the real topic of today's presentation, how to spot and avoid investment scams. A survey done by the FWRO Foundation found that 8 in 10 respondents were solicited to participate in a potentially fraudulent offer. Of that group, 16% of all respondents invested money in response to at least one of the fraudulent offers. And 11% of all respondents lost a significant amount of money after engaging with an offer. The research also estimated that fraud costs up to $50 billion per year to investors. So let's say you are called or approached by someone to make an investment. How do you protect yourself? The key is knowledge. FWRO's study found that those who arm themselves with knowledge about the methods scammers use and the types of scams that are out there are 80% less likely to even engage with the bad guys. And if they do engage, they are 40% less likely to fall for the scam. So what we want to do today is arm you with some of that important knowledge. What we're going to cover today are common red flags and persuasion tactics that scammers use, common investment scams, and where to research both the financial professional and the investment product. First place we'll start are the red flags of fraud. Here are the things you want to keep an eye out for. First, unsolicited offers. Second, offers that sound too good to be true. Third, pressure to invest quickly before you've had a chance to think about the investment. Next, a person soliciting investment who is not licensed or registered with the SEC or any state. Also, lack of documentation like a prospectus or an offering memorandum. Now let's talk about some of these red flags in greater detail. First of all, red flag number 1, an unsolicited offer to invest that comes out of the blue, usually from someone you don't know or someone you've met but don't know much about. Sometimes these come in the form of cold calls, but they can also come through emails or texts or direct messages or posts on social media. You may also hear radio ads or a paid radio spot. Many of the Saturday and Sunday morning financial shows that you hear on AM radio are essentially paid advertisements intended to draw in investors. One oldie but a goodie is an invitation to a free lunch or free dinner seminar. The promoters hope that by giving you something free that you'll feel obligated to make an investment. But as we know, there is no such thing as free. In any of these cases, you should tread very carefully if you didn't seek out the investment. or you didn't reach out to the salesperson yourself. Do your homework before your money goes out the door. If you're feeling tempted, look at some of the resources that we'll be sharing later today. Or better yet, just walk away. Now let's look at red flag number 2, pressure to buy. The opportunity sounds too good to be true. We all know that things that sound too good to be true usually are. You can spot these pretty quickly. Usually, the promoter or salesperson tells you that there's a chance for high profits, but little or no risk of loss. Or they'll tell you that your principal is guaranteed and that there's only a high upside. Many times, they'll tell you that their customers or clients have never lost any money, even in a down market. Another common tactic is to make it sound like this is a chance of a lifetime that will unlock your dreams, that it's a way to pay off your debts, or to buy that RV or vacation home you've been looking at, or to fund your children's or grandchildren's college. Sometimes they'll compare the investment to a well-known stock index, like the Dow or the S&P 500. And they'll always tell you that their investment outperformed those indexes. Why? Because they want you to think that your own mutual funds and ETF investments in these indexes are inadequate. You'll also frequently hear references to famous investors like Warren Buffett or Bill Gates, together with claims that they or their organizations are hot on this investment or this industry. Usually that's not true, and the promoters are simply trying to convince you that if one of these famous investors has gotten into this investment, you need to do it too. The bottom line is that when you hear or see these kinds of warning signs, it's a sure bet that this investment is probably very risky and possibly fraudulent. That brings us to red flag number 3, pressure to buy right now. This is a big red flag because legitimate investments do not require immediate action. And legitimate salespeople and investment advisors know how important it is that you have a fair time to fully consider any investment opportunity. The bad promoters, though, use this tactic because they count on people having FOMO. And if you have kids, you know what FOMO is. It's the fear of missing out. It's the fear that you have an opportunity here that if you don't act on it, it's going away. Or that your friends will get on it and they'll look at you as though you don't know what you're doing. So promoters say things like, you don't really need to think about this because this is a one-time deal only today. Or they'll say, look, if you don't want the chance of a lifetime, I'll give it to someone else who knows a good deal when they see it. Or they'll say, what is there to think about? Don't you like making money? If you hear anything like this, you should hang up immediately and walk away because that investment is almost certainly not honest. Now let's watch now to see a dramatization from the Hollywood film Boiler Room of exactly how a high-pressure salesperson goes about their business. See if you can identify the red flags.
Hi, Dr. Jacobs. This is Chris Marlin over at JT Marlin.
Marlin?
Right, he's my father.
He's my mother.
So my associate tells me you're interested in one of our stocks.
Your wife's on break.
I will call her back. Yes, MSC sounds like it might be interesting.
Might be. Might be doesn't sell stock at the rate MSC's going for, Dr. Jacobs. We're talking very high volume here.
Oh, well, I still have to run it by my people.
That's great, Doc, if you want to miss yet another opportunity here and watch your colleagues get rich doing clinical trials. And don't buy a share and hang up the phone.
Well, hold on a second now. I didn't say that. I just want to talk about it some more.
Honestly, Doc, I don't have the time. This stock is blowing up right now. The whole firm's going nuts. Hold on, let me open up the door to my office. See that, Doc? That's my trading floor. Now I have a million calls to make to a million other doctors who are already in the know. I can't walk you through this right now. I'm sorry.
The crush or the kill is emotionally driven. It's not logic.
If you apply logic to this concept, it's no. I'm not going to send you my hard-earned money. I don't even know who you are. I know you from Adam. When I wrap that in tons of emotion, that blurs. The logic goes out the window, the emotion kicks in.
Okay, let's do this.
Now, since you're a new account, I cannot go any higher than 2,000 shares. I'm sorry.
2,000? Are you nuts? That is way beyond what I was thinking. 2,000? Jesus. Listen, I'm curious. Why can't you sell me any more than that?
Well, we like to establish a relationship with our clients on something small before we get to the more serious trades. Let me show you several percentage points on this small trade, and then we'll talk about doing future business.
That sounds good. Give me the 2,000 shares.
Done.
You sure you can't do any better on this one?
I'm sorry, Dr. Jacobs. I can't. I'm sorry.
Oh, all right, we'll start with this trade then.
Great. I promise we'll swing for the fences on the next one. Do you want that confirmation sent to your office or your mansion?
Very funny, Mr. Marlin.
Let me put my secretary on, and she'll take down your info. It was a pleasure doing business with you. Done and done.
Well, hopefully, you spotted many of the red flags that we've been talking about in that clip. The salesman called him out of the blue. They didn't know each other. The salesman promised really high profits and a can't-miss opportunity. The salesman then pressured the doctor to buy right away, or else he was taking the opportunity to other doctors. That's a classic use of FOMO, the fear of missing out. The salesman also used some other tricks that you can see on this slide, like scarcity. He would only allow him to buy 2,000 shares, which he baited the doctor into wondering why he couldn't buy more. He also used social consensus, the idea that many other people are already getting rich from this opportunity. And that's a lot to pay attention to if you're an investor. So what should you do in these circumstances when you're confronted with a cold caller? Let's take a look at an example of how to handle a call like this.
Hello? Hi there. Hi, is this Mr. Rucker?
Yeah.
How are you tonight, sir?
Good.
I'm good, too. Let me tell you why that's so funny, Mr. Rucker. My name is Good. Ron Good.
And why are you calling, Mr. Good?
Well, I'm a money manager with the Dunkington Fund. You came to a seminar a couple weeks ago. I'm just following up on that. Dunkington Fund, I imagine that name's familiar to you if you know anything about investing.
Are you a registered broker, sir?
Oh, yeah, we're registered with everybody. In fact, we won an award.
Well, see,
let me ask you a question, Mr. Rucker. Are you interested in making money?
what I'm interested in is getting your registration number and a phone number where I can call you back after I verify things, okay?
Well, you could do that, but by the time you call me back, the opportunity's going to be gone.
Well, I guess you better call someone else.
So what do you think about that example? What did we see? Who was in control, the salesman or Mr. Rucker? Clearly, it was Mr. Rucker. He asked the right questions, showed that he knew the rules and that he wouldn't be fooled and wouldn't take no for an answer. Ultimately, Mr. Rucker shut down the salesman. Do you think that salesman ever called Mr. Rucker back? I bet not. Probably put him on a list that he would never call that person again. We want you to be more like Mr. Rucker. So now that we've identified the common red flags, let's identify some of the types of scams that are often used to target senior investors. We'll start with Ponzi schemes. A Ponzi scheme may look at first glance like a legitimate investment, but many of these scams promise unrealistically high or consistent returns, and the scammer may be using money from new investors to pay promised returns to early investors, and may or may not be investing in anything in an actual venture. The sellers and the investments themselves are often unregistered, and they may be very complex and difficult to understand. And usually the promoters want it to be that way. They want it to look like a black box so that you won't be able to see how they're using your money. The next kind of scheme is called it's called an affinity fraud. An affinity fraud are schemes that rely on relationships and membership in a similar or identical group. For example, people of the same race, or people who are of the same religion or live in the same community. The idea of an affinity fraud is to draw upon that commonality to increase trust, to make you let down your guard. The idea is very simple. Because you are both in the same group, you can trust each other. Think about it. When you see a television commercial featuring an actor of your own generation, aren't you more willing to listen to that person than someone much younger? The affinity suggests shared experiences and common beliefs and goals so that you want to trust that person more. But don't fall for it. Be skeptical and apply the same rules. You need to check the background of any seller before you invest, even if they're from your neighborhood or attend your same place of worship or share a common background. You should always research the investment and the investment professional. Another kind of investment scam involves what are called penny stocks or microcap stocks. These are the cheapest of stocks and are often used in a scam called a pump and dump. Penny stock companies are usually very, very small, and they typically have no earnings or assets or any real business, and they don't trade on big stock exchanges like the New York Stock Exchange or the NASDAQ, but are instead traded over the over-the-counter or OTC market. The pitch for these investments usually involves telling you that it's a chance to get in on the ground floor of a company that's just getting ready to do something big. A good recent example of this is COVID-19. There were numerous false promotions about companies that supposedly were working on treatments for COVID or that had developed equipment that could be used to treat or protect against COVID. Unwary investors who didn't take the time to look at these companies to see if they had any real assets or revenues, or that just a few months ago they were engaged in a completely different kind of business, got burned by investing in these companies. Because what happens is that when the promoters hype the stock, which is called the pump, it attracts investors to come and drive up the price. When the price gets to a certain level, at that point, the promoters sell or dump their shares. At that point, the stock has no real market, and the investors who are left holding the bag typically lose all of their investment. And the reason for that is there really is no market for these microcap or penny stocks. My general advice is to avoid penny stock investments unless you have a very high tolerance for losing all of your money. The last scheme we'll cover is the advance fee scheme. Have you ever been told that you won a contest or a lottery, but you just have to pay the taxes beforehand? Or that there's a processing fee or upfront fee that you need to pay to unlock an account or untold riches? These are examples of what is called an advance fee fraud, where the scam artist tries to convince you to make some sort of payment, whether a tax or a fee or a commission or some other kind of incidental expense, before you can get your winnings. Of course, there never are any winnings in these scams. Once you pay, all that happens is that you never hear from the promoter again, and your money is typically gone. So whether you're approached by a cold call with these kinds of scams, or see an email or a fancy website, don't fall for it. Now let's say you've been approached by someone about an investment, but you followed the rules and said you've got to go and research the investment and the salesperson first. Where do you go for information? Here's where you go. The easiest place is investor.gov. This is the SEC's own website that you can safely browse at your leisure. You can easily search for an investment professional by name or by firm. just by typing their name in the Check Out Your Investment Professional box. This will show you whether they are licensed and registered. It will also show you their employment history, including which firms they have worked for and for how many years, and the other kinds of industry experience they have. You can also see if this is a person who's jumped from firm to firm after very short periods of time, which can be a warning flag of a potentially dangerous investment professional. You'll also be able to see important disclosures about this investment professional's background. Let's take a look at more detail of what we should be looking for in an investment professional. The first thing you should look for is confirming that the person is registered and licensed. That will appear in green if they are. If it's gray, then that means that their license or registration has expired, and you'll want to find out why. A key thing to look for is whether they have any disclosures of customer complaints or disciplinary actions. If the disclosure reported area appears in red, that person has had a complaint or a sanction or a judgment filed against them. You should click Get the Full Report so that you can see the details before you proceed with that investment professional. Even if there are no disclosures, the full report is where you can see a history of this person's employment in the securities industry. Now, to be clear, there are some professionals who do not provide investment advice or sell securities and are not required to register with the SEC. These are typically insurance salesmen who are required to be licensed and registered with state insurance companies, state insurance regulators. However, these professionals can only sell you products like fixed annuities or equity indexed annuities. If they're selling you variable annuities or any other kind of security, they're required to be registered as a securities professional with the SEC, a state, and FINRA. Let's drill down a little bit about disclosure events, because this is an important place where you can find out whether your investment professional has had trouble in the past. This is what we would see if we had an investment professional who had disclosures. We would see a screen that's red, and it would list by date the particular kinds of events in this professional's past. Here you can see potential criminal charges and convictions, formal investigations and disciplinary actions by the SEC or other regulators, customer disputes and arbitrations, and financial disclosures such as a bankruptcy. You should also be able to see their registration history, which tells you when did they get licensed, what licenses do they hold, and what firms have they worked for and how long. Another thing that I want to convey about salespeople. Some salespeople use credentials that can be very confusing. In particular, they may use credentials that suggest they have some sort of expertise or specialization for retirement or seniors. Sometimes these professionals are in fact legitimately credentialed. If someone is a certified financial planner or CFP, for example, they have very specific educational, experience, and testing requirements and owe fiduciary duties to their clients. You can check out if someone is a CFP by going to the CFP board's website. But often, these titles have little or no meaning. Some, like elder care asset protection specialist, have very unusual or hard to detect credential requirements and have little or no oversight by any credentialing body. Others, like senior specialist, are basically made-up designations that have no meaning whatsoever. If you're confronted by one of these titles or credentials, you should check them out here at finra.org/professional designations. That has a long list of virtually every kind of special designation that exists in the industry, as well as a background of how reliable that designation is. In addition to doing your due diligence on investment professionals, you can also research the particular investment you are considering. We have a tool called EDGAR that allows you to research publicly traded companies, mutual funds, and variable annuities. EDGAR is the SEC's online database of corporate filings as well. You can learn important information from filings that these companies are required to make with the SEC. This is also critical because a lot of scams involve unregistered companies, which you won't find on EDGAR. In other words, if you're pitched an investment and cannot find any information about it at EDGAR, that's a good sign that that could be a high-risk investment. So what would we see if we went to EDGAR? This is what EDGAR's page looks like. And once you type in the name of the company there in the box, it will pull up a variety of information. It will send you a copy of the company's registration statement, its periodic disclosures and filings with the SEC. If it's a publicly traded company, you'll also have information and filings regarding the stock holdings of officers and directors of the company. And you'll also be able to see the company's audited financial statements. And remember that we have a useful tutorial on EDGAR that shows you how to quickly research a company's operations and financial information. Be sure to click on that when you go to visit EDGAR so that you can better understand what you're seeing. So where else can you go to find help? For seniors, you would want to start at investor.gov. And at investor.gov, we have a page specifically devoted to senior investors. It's investor.gov/seniors. There you can see a lot of the information that I've shared today, where you can take the time to read it in greater detail so that you're better prepared and better armed with knowledge for any cold calls or unexpected investment opportunities that come your way. This site also has relevant articles, resources, and information about the kinds of questions you should be asking of your investment professionals and your investments, even if they're legitimate. That's all I have for today. Thank you very much for your time and attention.